Happy Monday, traders, and welcome to a fresh week, which is guaranteed to see a lot of volatility. Okay, on Friday, we did have some important economic data come out of the US. That was the monthly payrolls data for February. Market was expecting plus 60,000 on the headline and the unemployment rate to stay steady at 4.3%. But the actual data came in much worse than expected. So the headline number came out at minus 90,000 job losses, and the unemployment rate going up to 4.4%. But even further to that, we got some revisions to the previous months, and those revisions were down as well. So the 3-month rolling average for the headline number now is pretty much at zero. So that pretty much means that the labour market is not doing too well. At the same time, what we do have is that obviously we've got a crude spike that's obviously inflationary. So we've got a worst case scenario brewing at the moment for the economy and for markets, in that rising unemployment at the same time that we have rising inflation, and that is stagflation, not good again for markets, the economy. So moving forward, it's going to be very hard for the Fed. They're painted into a bit of a corner with cutting rates. So in the background to this war, we do have a serious situation brewing with economic data deteriorating or going the wrong way. Okay, so in markets as well, the focus is obviously it's crude. We've been talking about this since the war's obviously started. Crude closed on Friday at above $90. Absolutely sensational move over the week, up a whopping 35% for the week. It's one of the biggest weekly gains ever for crude. Now, over the weekend, all of the news with respect to the war was negative, especially for crude. In that Israel actually did bomb some of Iran's oil infrastructure. Iran has come out quite forcefully and said that they will retaliate and hit regional oil infrastructure as a response. And at the same time, we've got a lot of the Gulf nations where their storage capacity now is full, so they're having to stop production on energy. And we've also got the Strait of Hormuz closed as well, and that looks like that's going to obviously stay that way maybe for an extended period of time. So all of this is super bullish for crude. We've just seen the markets open for Monday, and yes, we have seen crude spike above $100. So far it's gone up to 110, so it's up another whopping 20% on the open on Monday. And obviously that is not good for risk in general. So the markets and the world's worst case fears is coming to fruition with this crude spike. At the moment, a lot of analysts are still looking for levels even well above where we are at the moment. Thinking that anywhere between 120 up towards 150 is possible in the short term this week. But the real doomsdayers, I think it may be even 200. But in any case, look, you are trading these markets, you are a crude trader. So the higher it goes, it's going to take risk lower with it. And if for whatever reason, we do see crude come off its highs, obviously then that'll be a positive for risk. But in any case, what is going on is certainly a massive negative. Okay, so in other markets, equity markets on Friday, yes, they had a poor session on the back of the payrolls and obviously what's going on with crude. So S&P and NASDAQ were both down around about 1.5%. They have reopened on Monday just then, and they have gone down, gapped down another 1.5%. Now look, yes, we are seeing US equities lower, but I'd say that so far what we're seeing has been actually quite orderly. We haven't seen any real violent sell-off in US equities or any sort of capitulation or any minus 5% plus down days. So I would say that potentially that is the risk. US equities have technically traded sideways now for a good 4+ months. And generally, when you break those ranges, you do get some good momentum, some violent momentum on break. And it looks as if we're right there now, breaking that range. So the risk is that at some stage, even though we're down 1.5% now, again, it's still, considering crude is up another 20% and trading around that 110 level. Still seems a touch orderly. So, and we are coming from levels that are super close to record highs. So I think that's a risk. Maybe we do at some stage see a violent move in equities. As far as gold's concerned, it did have a good close on Friday. Close up towards the 51.80 area. That was helped obviously by the bad payrolls and also the fact that going into the weekend, no one wants to be short crude for the gap risk. But we've reopened, and at the moment, gold is trading around Friday's close. So we haven't really made any strides topside. And I'd say that, look, gold is not the easiest trade anymore. Previously being long gold obviously has paid. It does continue to pay buying dips, but sometimes chasing the rally is not the best strategy. For the simple reason is that obviously what is happening with crude, inflationary, what we see is obviously bond yields spiking up, gold yields nothing. So it doesn't like bond yields going up. Global bond yields are doing that. And then also the fact that in the currency market, we're seeing the US dollar strengthen quite aggressively. Gold trades inverse the US dollar. So when US dollar strengthens, it weighs on gold. So there's a couple of reasons there for gold not being the easiest trade, just one way bet. But also, if we do see huge risk off, a lot of the times traders, if they do have profits in gold, they're going to sell those, lock in something to pay for losses in other markets. So be careful with trading gold, and it's obviously trading huge wide ranges as well. Look, in the currency market, we've talked about this before, but keep it simple. The Aussie dollar is a risk currency. It's a premier risk currency globally. If risk is selling off, the Aussie will go lower. It has opened sub 70 cents. I'd imagine with what's going on, obviously it'll stay sub 70 cents. And depending on how aggressively risk sells off, will depend on how far Aussie goes lower. But certainly, if you're taking positions in the currency market, the easiest one there is the Aussie, because it's high correlation with risk. Anyway, look, the bottom line is that we're going to see huge volatility. Sometimes it won't be just in one direction, and that's what volatile markets are. You do get two-way volatility. We've had a lot of gap opens, especially lower for risks. Markets do tend to fill those gaps. So if we fill it in the short term, we're going to see some of that two-way volatility. But in any case, you are a crude trader, whether you know it, whether you like it or not. So you got to watch crude like a hawk, and that will obviously dictate where these markets are going to go and potentially how low we're going to sell off. In any case, good luck with your trades, and we'll check back in with you shortly.